Expiration. It is roll week here for small exchange futures. You've got small exchange futures ending in U21. That is September futures, and they got to go. They got to move on and become V21's October small exchange futures. That's the roll from September to October, happens once a month. But I thought it was a good idea to, or I guess a good time in the calendar to talk about what expiration is, and how we deal with it as traders, and what maybe some of the differences between futures and options expiration, and so on and so forth. I mean, looking at the initial definition of futures here, the key part that we're digging into is the fact that, futures are agreements to buy or sell an asset at a specified quantity and date in the future at today's price. And so that expiration here for Friday, we're not there quite yet. It's Friday at 3 p.m. Central is the expiration for small exchange futures. Still, right now on Wednesday afternoon, right now you can trade the price of where those markets will be on Friday at 3 p.m. And there's still a little bit of time, but you want to take those 3 days worth of time and expand it to more than 30 days by rolling. But I mean, is there any hangups that you have with what expiration is vis-a-vis this definition?
No, I think it's a really important component of a futures contract. Any derivative, there has to be some kind of expiration day. It's really what keeps the futures contract in line with whatever it's tracking. Because if we go back to our agricultural example, you lock in a price for your soybeans that you're going to sell at the end of the season. You need to make sure that the price of the soybeans converges to that final sale price. Otherwise, that contract can kind of just move willy-nilly on its own. There's nothing keeping it in line to track what it's supposed to track. So it's really the necessary component that makes the future work. What's kind of interesting, especially with small exchange futures, is that most of them have an underlying index that you can track. I don't know if you have an example in here, Frank, but I would just say with small stock 75, you can look at the future /SM75, and you can also look at the index on Tastyworks 75:SME, and you would see on the third Friday of the month at expiration, the futures price will converge to that index price. And that's what keeps it kind of responsible and ensures that you are indeed getting exposure to what the future is supposed to track.
Yeah, we're going to get to a very simple example of that dichotomy very soon here. But I do like a piece of what you just said there was really, really nice and eloquent, which was that derivatives have to have an expiration. And internally, to lift the curtain a little bit, here at the Small Exchange, we've had countless conversations about how can we get it so that our futures, they don't have to be rolled, because it is kind of, it's not a big nuisance, but it is, once a month you have to spend 2-3 minutes being like, all right, I've got to take off my SM75 U21s and put them on in October. And it's a pain in the butt. And a conversation that usually comes up among maybe people who aren't as well versed in the derivative space is like, oh, well, why don't we just make a continuous future contract? And it's like, that's a really nice idea. It's a future that never expires. It just keeps on going. And it's like, well, then it's not a future. It's just like kind of this thing that exists. And like, what date is it supposed to kind of correlate with, and what keeps it in lock with the index? Because the idea is like, if there's a future that expires on Friday of this week, and the market, the index that it's based off of, the spot, the cash market, whatever you want to call it, is at $10, that future is probably going to be at like 10.10 or 9.90 or 10.15 or 9.85, kind of around the index. But if you have an index, a spot value, a cash market like the S&P 500 or like corn as it trades here today, and you have a continuous contract that doesn't have any expiration, I don't know what keeps it tethered to any, short-term movement in the market, or what keeps it, 20 cents, 30 cents, 50 cents, $1, $2. Like it could really, really get out of hand. Now, the other thing we've talked about, and I think this is actually where technology is way closer to with brokerages and platforms, is an auto roll functionality, which is like I go in there and I buy, the small cannabis futures, and I can like click something that says like auto roll this on expiration week, and I don't have to deal with it. And it continuously gets that thing moving on to the next month until I finally want to sell out of it. But I mean, do you have any insight on that whole continuous versus auto roll versus where we are here in 2021 where you got to do it manually?
Not a developer for a brokerage platform, but I would say that we got to be pretty darn close, or at least be close to experimenting with the idea of like short dated and longer dated futures contracts. But real quick, Frank, I just want to step back for a quick second. If you're very new to futures contracts, this concept of expiration is also related to this concept of month codes. And I was wondering, Frank, if you could just give us a 20 to 30 second explanation of why these month codes and what they mean when you actually type the symbol into the platform, because it's really important in relating to expiration.
So yeah, I guess that's a good way to ground us here, because we have gone a little bit on just like the theory of expiration, why they exist, and why they exist in derivative spaces and everything else. That when you get down to it and you're like, okay, well, what expiration am I in, and what how do I even know which one to be in, and where am I here? Yeah, there is a month code. It's the extra kind of bit on top of to the right of your future symbol. So if like you search ES, the mini E-mini S&P future, the platform will populate with a month code after it. And right now it'll probably populate Z21 or Z1, which is telling you Z is December, as you might have guessed there, last alphabet letter there, last month of the year. And the 1 or the 2-1 is denoting the year that month is expiring to. And then there's obviously a letter that correlates with the other 11 months, and then the year that follows. And so you could have, Z22, Z23, Z24, and so on and so forth. And then, January is F, and the stuff is a little bit scrambled because guess what? There are more alphabet letters than there are months in the year. And they don't want to use any alphabet letters that look like numbers. They don't want to screw with you on that and use an L and be like, is that a 1 or an L when I'm searching in the platform? So yeah, they all have the month codes. You can look them up pretty easily, and just know that like the one that you want to be in is the one that has the greatest volume. Mm-hmm. And if I have one if it is September and I've got a month code that is September, and say it's the second week of September or the third week of September, that is pretty much bad news, and I need to look into rolling it to the next one. But let's get to our example here to try to illuminate what expiration is a little bit further, because it is that date when the futures contract concludes trading. And so, maybe today the market's trading at $5 and the expiration, Mikey, isn't for a month. And this is this relationship that we keep coming back to, is like, there is a market for anything like corn or like stocks or interest rates, anything at all. There's a market for it today as it currently lies. And then there's a market, the futures market, for it next month or the month after that, the year away from now, 2 years from now. And that futures price is going to build in a few different things, and it's going to spit out where, buyers and sellers meet on where that market should be in a month from now. So, there's, I don't really want to use a real world example. I kind of want to work with this that we have in front of us, this theoretical, where it's like, there's a market today that's priced at 5, but there are a lot of buyers for this market in a month from now. They think it's going to be at 6 in a month from now. And so those futures are trading at $6. Now, as we approach that expiration, either that spot market will have kind of moved up to meet traders' expectations, or traders' expectations were incorrect and sellers will emerge in that future and bring it down to where it is trading today, because next month now has become next week. And say the index hasn't moved at all, the spot market hasn't moved at all, those futures are likely to come down a little bit And then it becomes this situation of, well, if I was long the next month futures and now those next month futures are next week because 3 or 4 weeks have passed, now I need to roll that into the next month there when the date approaches. Otherwise, if today and my future become one, then my future goes through expiration. It gets delivered. Small exchange futures just settle to cash. So nothing happens. The cash just goes in and out of your account depending on whether you made or lost money. But your trade is gone when that future date finally comes up to today. And that's why you look at rolling.
So to kind of analogize it to options a little bit, let's say you're long the 100 strike call option, and at expiration, the underlying is $105. My option is going to be in the money at expiration, and it's going to be auto assigned. And I'm going to purchase those shares at $100.
Yep.
Now that option is worth at least $5 in intrinsic value. So I can do with my position whatever I want, right? With futures, if you're long a certain contract, let's say you bought it at 100, and at expiration, it settles to 105, that position on my account is just, it disappears, right? I'm just netted basically $5. Happens a little differently because there's like intraday margining and stuff like that, but that's essentially the premise, right? Like my position is gone and I no longer have exposure to that future.
That's exactly right. That's with cash settled futures. And that's all the futures at the small exchange there. Now there are institutional futures out there, like your crude oils and some metals and other agricultural products, where at expiration, you do get on your books the cash version of that, which is big and costly, and you really don't want it. That's called delivery. But with cash settled futures, Mikey, you're exactly right. You know, let's stick with this example here. Let's say I bought the futures for next month at $6 and I lost $1 on it, and the market is going to settle its expiration day today. The market's going to settle at $5. Then I just lost $1, and come Monday of next week, I don't have any position, but the dollar is out of my account. But yeah, with whether you're long options, short options, long futures, short futures, if you want that trade to continue, you know, maybe you bought those $6 futures, you're out $1, but you want to defend it, you want to keep going with it for another month, then all you have to do is just get out of that position and then get into the next month's version via rolling. And we have a lot of content on how you roll. It's very, very simple. Essentially, if I'm long in the expiration that's about to hit, then I sell that contract and I buy the next expiration, vice versa for shorts. Now, here's the general rule of thumb for, hopefully you understand what expiration is. You understand how it factors into trading futures, a lot simpler than options with the strikes, calls and puts, all this different stuff. I'm either long or I'm short. It's above or below where I bought it, so I'm up or down money. Now, what expiration do I deal with? The general rule of thumb here is the active expiration, where I want to be, has the highest volume. So if you're getting confused, say it is September, and you know September is U, and you know October is V, and you know December is Z, and it's like, which one of these three should I be in? Well, just quickly check U, check V, and check Z, and compare the volumes that you'll see in your platform, and the highest volume one is the one that you want to be trading.
Wow, that's actually super simple. And if you want to see what those month codes are, you can just do a Google search for futures month codes. I think we have a resource on the Small Exchange website. With our futures here, there are only ever 2 outstanding months at a given time. So today we're in September. We haven't yet hit that third Friday. So there's an active September contract, but then there's also the active October contract. And I just want to bring this to a contextual example. I'm looking at 2-year interest rate futures, which have just gotten decimated recently. If you're looking at them the same way that I'm kind of looking at them, which is, wow, they're at an all-time low, and you're bullish on interest rates and you want to buy 2 years for the medium to longer term, all you have to do is buy the outright, and when expiration comes, roll to the next month to maintain that exposure. Generally, that roll is going to be most liquid and tightest in their spread between front and back month this week. So it's like Tuesday and Wednesday of the expiration week. So if you're long those interest rates and want to maintain the exposure, just sell the front month and buy the back month if you're bullish. So Pretty
Awesome,
straightforward.
Mikey. Great. Yeah, great example there, especially one like 2 years that could take a while that you probably have to roll a few times. But
Mhm.
yeah, decent trade nonetheless. Thanks so much for covering expiration with us here today on Small Stakes. It's been a ball, but about to have another ball here with Peter Momat. Splash into Futures is coming up next. Got a lot of trades here. A weird day in the market. A lot of stuff to do in intra asset class, weird movements. Some stocks are up, some stocks are down, some commodities up, some down. Same with interest rates and foreign exchange. We're going to cover all of it and get some trades out there next on Splash into Futures. Thanks for watching, everybody.